I'm not sure which one to take. It says if you're applying for a car and battery license, it's $135, but then inside of it, it says $230.
I mean, is that typical? I know that
Okay, let's get started. I've got 1 minute Everybody here? Before I introduce our panelists tonight, does anybody have any questions about ready for next week pitch night?
Can I suggest some sedatives in the food, please?
I don't know if we can do that or not. Sedatives in the food next week. I'll have to.
Come on over, Jerry.
I'm
lonely over here.
Yes, will be here. Hello, hello. It'll be in here. I would highly recommend that you come early, especially if you're doing a carry-forward to test it, and if you have your stuff on an Apple device, if it cannot be converted to a Microsoft device, you'll need to bring your own tablet or computer. It's been a long day. I was about to lose. Had a lot of windshield time. Also, we'll have to check to see if the adapter that they have to work. If you are bringing your own computer, make sure it has an HDMI port, because that's how we connect into the projector here. Remember, you've got 8 minutes. I would suggest the rest of this week, if you can find somebody to sit down and you could practice, do it. But next week is the week, and we'll have 5 or 6 judges. So be prepared. If you're going to bring handouts, you better have enough for at least 6. That's totally up to you. However, that's your 8 minutes. What you do with it is totally up to you.
I've got some time reserved, so if anybody wants to come and see me and run through your pitch and get some feedback.
And just remember that your business plan is due end of that week, the first, March the 1st, 5 o'clock.
March 5th.
5th.
So another week.
March
Thought it
5th.
needed to be the first time.
March the
Had to
5th.
be postmarked by the 1st. That's what, I looked at my email today, that's why it's.
But she has to be at the office by the 5th, because the reason we're keeping on that is on the 6th that morning, I'm driving all your business plans, which will need 3, out to all the judges, because they have a week to review those and score those. So that's why we have to have a drop dead time to get them in here.
But we're able to email them? You're talking about mailing.
We can't print them.
Not all those copies, okay.
Yeah, and remember, your guidelines state no more than 20 pages. Surely you can tell about your business in less than 20 pages, but again, these folks are volunteering their time, and I'm sure they don't want to spend hours on one business plan.
Sorry, but for the pitch night, we do not have to have any sort of plan.
No.
To give
But
to
if you want to give a flyer, some people that have restaurants, they bring samples. It's your 8 minutes. How you want to sell your business is totally up to you.
So we have 8 minutes. Will they ask questions during?
Yes, and we
during
use
that 8 minutes
and
or
we
after?
after.
Okay.
And we usually allow 1 to 2 minutes. We try not to go more than 10 minutes because there's a lot of you, and we can be here till midnight. So again, we try to be cognizant. As you're doing your presentation, they'll make their notes and they'll know what questions to ask. Okay. Anything else? Well, thank you all for this tonight's first of May. And as you start and grow your business, that's something you're going to be always looking at. Is as you grow, you got to be able to have access to financing. So tonight we have 3 great panelists from a diverse group of financial institutions. I'm going to let them introduce themselves and tell about what they do, and then we will go from there. I hope everybody got a lot of questions. Okay. So, Ernie, you wanna take it away?
Well, good evening, everybody. My name is Ernie Matty. I'm the commercial real estate loan officer for Southwest Virginia for Virginia Community Capital. Virginia Community Capital is a for-profit bank that is owned by a nonprofit, CDFI, which makes us a little different than your normal bank you went to. We're actually the only one set up like that in the state of Virginia. There's only about 10 or 12 around America that's set up with the same structure that we have, which allows us to be a little more mission-driven than what you would see from a normal bank. We're community development minded, so if it's something that's going to create jobs, it's going to bring old buildings back to life, put new buildings on the tax tickets around the communities we work in, are the type of deals we kind of look for. We are a small business administration 7A lender. We're a preferred lender for this SBA 7A loans, meaning we don't have to send all that to them in the beginning. We can actually close the loan and just then move it out after the fact, so it speeds up the process for you. We'll do, again, small business lending, we do commercial real estate. If you're gonna be in a building that you're gonna own, owner occupied, we do that as well. If it's gonna be a building, you're just gonna lease space, apartments, mixed use, anything like that. We take a look at that as well. We're mainly a debt service lender, which means if the building will cover the debt with the leases or the business that's running it at 120% or 1.2 times, that's what we normally look for. So you'll hear a lot of different things on what a lot of the lenders look for. Just like any other bank, we'll look at your credit. We do have some different grants and things that we can do credit enhancements on. We don't make grants to for-profit businesses, but sometimes we can use that to do a loan loss reserve to strengthen a deal that you may be trying to get done. So anything we can do in any of those areas, we'd be glad to help. And congratulations for making it this far. Next week's exciting. The pitches are always fun, so good luck on that.
Thanks.
I'm Jeff Fritz with Highlands Union Bank here in Abington. I'm a commercial loan officer, doing a little bit of everything as far as commercial lending is concerned, commercial real estate, as he mentioned, along with working capital loans and lines of credit. We are, of course, a commercial bank. We offer checking and savings accounts in addition to loan products. Along with our checking and savings account, we do merchant services, which are your debit and credit card machines. We've got a great debit and credit card program. We offer the type of machines that plugs into your telephone line or into your personal computer, or we offer the square type device that you've probably seen that plugs into your cell phone or to your iPad. We service those as well. We do remote deposit capture. If you have a checking account with us, we can bring you a machine that plugs into your personal computer. If you take a check, you stick the check in that scanner and it goes directly into your checking account almost immediately. We love our community. We're proud to be a part of the chamber. We are offering some special deals here very soon to small business owners. One particular deal is for an owner-occupied building. If you're going to purchase a building for your business, even if part of that is income-producing property, if you're going to rent part of it, we're going to be offering some special rates and terms on that here in the very near future. So you can look at us on Facebook or LinkedIn or even in the newspaper and see what we're offering from time to time. Certainly I'd be happy to talk to you anytime. We have David Ray and Philip Deal over here in our Abington offices. They're also commercial bankers that would be happy to talk to you. Certainly if you ever have any questions, we would love to talk to you. We as he mentioned, are basically cash flow lenders. Most of us are anymore. We look at the what we've always called the three-legged stool as far as that's concerned, character, capacity, and collateral. Character being your credit history, how well you've handled your credit in the past, whether that be in personal business loans or checking, savings accounts. We look at those. We can even call your personal references if you have references that are not reported through the credit bureau. We look at the collateral that we're loaning against, that is the building or inventory, equipment, accounts receivable. We do some commercial leasing as well through a partner that we have dealt with for several years. And then the third leg, of course, of the stool is your capacity, your ability to repay. And we do basically the same thing. We use a 125 debt service coverage ratio as our benchmark. And what that means is for every dollar that you have going out in monthly payments, that does not include insurance, utilities, and things like that, just monthly debt payments, we look for you to have at least a 1.25% return, $1.25 for every dollar on your net operating income. So that's something that we'll be happy to talk with you about. And you're going to run that into that situation with every lender that you touch base with, whether that be at our bank or our companies or any of our competitors. You're going to run into the same thing. So that's something that's important to get yourself acquainted with.
I'm Jeremy Repass. I'm with People Incorporated here in Abingdon. I'm a senior business lender in the Economic Development Department. Some of the lending that we offer to mirror what these gentlemen have said, some of the SBA loans that are available to folks starting up businesses are expanding. We also administer a grant that was started by Congressman Rick Boucher, which is the 9th District Development Grant that is based around tourism businesses. It's a really good grant that's out there now for those folks with tourism businesses. With the interest rate right now on that is like 3.5%. So a really good option for folks starting those type of businesses. The SBA terms and requirements that we're offering right now is at a 7.5% interest rate. I have a max of 6 years that I'm allowed to go on those SBA loans. With those, we are not allowed to use those to purchase real estate. Oddly enough, they can be secured with real estate, but they can't be used towards the purchase of that. The 9th District Development terms, they usually like to stay within a term loan of 15 years. However, we have done some balloon loans where we'll amortize those over 20, 30 years and put anywhere from a 3 to up to a 6-year balloon on those. Kind of just to mirror, I don't want to bore you again with the information that these gentlemen give, but we are a cash flow based. We do look at your cash flow projections. We do look at your credit worthiness. A little bit different than what traditional banks and some other lenders offer is we offer a 1-to-1 ratio. However, we try not to intervene, or we won't intervene until you have been denied by banks or someone like that if you didn't qualify for those. So like if you were to come to Jeff and you just fell below those 1.2 ratio on your debt service coverage, we may be able to step in and give you a little help to kind of help mitigate that into that 1.2% or greater, so that we can get you back into a bank qualified loan at a later time if it's a better option for you. So People Incorporated offers, a lot of services to folks, and particularly in those in the business startups, but we do require bank denial or something from the bank stating that they weren't able to accommodate you with your financing needs. So.
Okay, time for questions.
this could be for any of the three. If I have a startup business and I'm an LLC, are you gonna require personal guarantees from the members to do the loan?
Yes. I think I speak for all of us on
Yeah.
that. Right now, in the market, I don't know of any banks that are doing commercial or small business lending without a personal guarantee. Each bank has a little different requirement on who can make that guarantee. The way we work, if you own 20% or more of the business, you have to be a personal guarantor of it. So if you split it with someone, you both own 50, you both would have to sign. But if you were at 85 and they were at 15, they wouldn't. We're fine if they do, but we don't require them to sign. But anybody over 20% owner is required.
You did well.
So that's incentive to have more partners in LLC, right?
It depends.
Yeah.
Maybe we got another.
It depends upon the people that you have involved. There's a lot of risk in taking on partners in your LLC.
I've got a question. When trying to develop, of course, we're all in the process of working on developing our business plans and our cash flow projections. And I'm sure as a bank, until you have a proven track history of that type of performance, that's pretty much all it is kind of on paper plan. About how much of a track history does a bank typically look for before you will give credence or weight to those cash flow numbers?
We've done some startups. Obviously, it's a lot riskier to do a startup than it is an existing business with 2 or 3 years worth of tax returns. Our normal portfolio, we're going to look at 3 years of tax returns. But if it's a startup and you've been in that business for 25 years, you've got the expertise, we'll consider it if there's a lot, if you're putting a large cash injection into it. What I would say on your projections, if you're ever going to any type of lender for a startup with projections, know where you came up with the numbers from. Just don't say, I can do $10,000 a month, so I'm gonna do $120,000 that first year. What's it gonna take to get you to $10,000? If you're a restaurant, how many meals are you gonna have to serve? How many times are you gonna have to turn the tables? How many chairs are in there? What's each chair worth? Know what those numbers are, because that's what a banker or any underwriter is gonna look for. They're just not gonna say, well, if he says he can do it, he can do it. And most of your underwriters have seen thousands and thousands of projections. So if it doesn't make any sense, they're immediately going to know that's. And one thing they may not know your certain area. That's one good thing about kind of the smaller banks like Highlands Union, Virginia Community Capital is you've got local people looking at these deals, so they are familiar with your territory, and you've got a local loan officer that's working with risk and working with underwriting. So as long as you can prove that you've put in the time to where you came up with those numbers, if you went to a competitor, you spoke with them, or you've done the market research, just know where it came from.
Kind of to mirror what he said too in regards to personal cash injection and those type of things. If it's a startup business and we're kind of going blindsided to your projections, so to speak, if it's a new business that we haven't seen, along with that personal cash injection and so forth, what have you personally put up to secure the loan with? In layman's term, the more skin you have in the game, the more believable your projections that we're kind of blind to are going to be.
There a ratio of personal asset to loan that y'all can match, like 1 to 1 or 2 to 1, that sort of thing?
We try to hit at least a 1 to 1, but that all depends upon what's being presented to secure the loan with too. I mean, you think equipment and things of that nature, you're going to have you could have a massive depreciation there. Whereas if you're using land or real estate and those type of things, you get into a little different ballpark. At least for us,
Yeah.
it is.
Yeah, we normally look at, we're going to take a look and see what the total cost to get the project started is. We're normally not ever going to lend more than 80% of that, unless it's a mission deal and we can use a loan loss reserve or a grant to strengthen the equity or the collateral on it. But normally the baseline is going to be 80% of what it takes to get it started. And that's another thing while you're doing your business plans. I've judged these business plans a lot, and I've done them around the state. I used to work for the DHCD doing this program. Have proof that it's gonna cost what you're saying you need. If the first prize is $25,000, I'm not sure what it is, so don't think now it's $25,000 if it's not. Sandy will be hunting me down, killing me. Don't say that's what I need. If I get that, I can start my business.
Right.
Have it make sense. We got judge business plans, and first prize was $20,000. Every one of them needed $20,000. It's amazing. You can start 30 different kinds of businesses with the same thing. So know exactly what it is. And if you're going to go to a bank, don't ever walk in a bank and say, I need as much as you can give me. They want to know exactly what you need, what you need it for, how much you're putting into it, where you came up with the numbers. So you need to know your numbers when you're going to try to borrow money. Same as if somebody you didn't know came to you to borrow money. You wouldn't take everything they said for you'd want to know where they came up with those.
You say you want to know where, so show proof of, that I went and spoke with this competitor or this supplier or this, you want exactly in the notes or as far as a business plan, because you said that you had judged before, so I mean, is that?
Yeah, it can be, it definitely should be part of your plan because it's going to show you've done the research. There's a section in your business plan that should be for competition.
Yeah.
Just where you went, how you gathered that information, and how you're going to differentiate. If you're going to do the exact same thing they're doing, and they've been there for 10 years, it's going to be hard to get into that market. If you're not different, if it's either price or it's service or whatever, or just a little something different.
Just like he said, we look at past, present, and future. We look at your experience in the past, what you have done in the past, your expertise, whether we feel like that you have the education and the ability to pull off the job that you're going to be doing. We look at what you're doing today, and then we look at your business plan to see what you're going to be doing in the future. And there again, just like he said, we compare those numbers. And in most cases, if you bring a business plan that says that you're going to be profitable your first year, we probably are just going to throw it in the trash. Because 90% of the new businesses that start are not profitable the first year. I've been doing this about 30 years, working in a bank 40 years, and I think I've seen one business that has been profitable the first year. Yeah, so you have to back up your numbers, let us know where your numbers come from, and give us about a 3 to 5 year projection. Almost everyone wants to see a 3-year projection, and it's better to have a 5-year projection. And be conservative whenever you're building your pro forma to make sure that you don't overshoot. It's better to underestimate than it is to overestimate.
I've seen a lot of times I recommend people working from the bottom up rather than figuring out your gross sales and those type things and then breaking everything down, working from the bottom up, because when you're looking at a 1-to-2 ratio, all you got to prove is that, well, your ratio is 1-to-2. You don't have to blow it out of the water and become a millionaire overnight. It's not that. So sometimes working from the bottom up and knowing the cost associated with that business and coming up from the bottom, then you would understand how much cash you need. And if you've had, just like they said, experience in that business, I mean, sometimes a number can jump out and you're like, well, there's no way possible I could do that. If you're looking at a restaurant, I don't have that many tables. There's not that many days in a week, So, that's a good way to approach it as well, I think.
What is an acceptable loss, percentage loss? What do you look for? If you say don't make money that first year, what's an acceptable business loss for a first year business?
For me, it would be how quickly you can recuperate that in your cash flow.
And how you're going to cover that loss.
Yeah.
It's got to come from somewhere. So
Like you don't have a.
it could be, just what can you cover? If you've got a 20% loss, where is that 20% coming from? Because at the end of the year, that money's went somewhere. So is it coming out of your pocket? Are you going to have a line of credit? Are you going to have investors or family just investing, whatever it may be? You've got to be able to show, one, you can handle the loss. So some people may be able to handle a 50% loss, and some can handle 5%. So it's gonna be different for everybody, and every business is gonna be a little different as well.
Yeah,
So
that,
for your second year projection, it would be good to show where you're not gonna lose that same amount the next year?
Yeah, well, one thing you don't want to get in trouble too with projections is year one, you've got these numbers. Year two, we're gonna grow by 5%. Year three, we're gonna grow by 8%. Year four, 12%. How? Why? Just don't reach up in the air and grab the numbers. You've got to be able to back those numbers up. Because one, it's a disservice to you. Because normally people that go into business, they're all in. They've taken everything they've saved, and this has been their dream, and they're going into business. And it can very quickly turn into a nightmare if they haven't planned and they haven't really done their work to get those numbers as close. And again, they're still projections. You may not hit them, but
So if we're saying that we own our building, okay, need X amount to open our business, but we have small renovations to do to the building, and that's gonna be our loss for the first year, we're not gonna have that the next year.
well, yeah, that's easy to show.
legitimate?
That's easy.
Yeah, that's real
Okay.
easy to show. We're not gonna have this capital expenditure.
Okay.
But you've got a plan too. What if in year 2 or 3 you know you're gonna have a large capital expenditure? You've started at this level with this type of equipment. If you get to the level you think you're gonna be at in year 3, you've gotta buy new equipment. Plan for it. Have your capital expenditure. It may be putting back X amount of dollars every month, so you know in month 30 you've got to buy a $50,000 piece of equipment. Where's the 50 coming from?
what he said is what we look at as liquidity. How much cash basically you have in the bank or liquid assets that you can convert real quickly to cover the loss that you might have in the first year or two in order to get you in business till you can be profitable in, say, year 3, 4, and 5. And if you own a business and you're trying to grow that business, you have to be very careful not to grow too quickly, because you will lose your liquidity. Your cash flow will decrease, will go away when you're trying to grow a business, because it takes money to grow a business just the way that it does to start a business.
Is it better to do a line of credit if you don't need a whole lot, and to do a line of credit versus a loan?
Depends on how quickly you're going to need that and what you're going to need it for. Now, a line of credit is like a credit card. It's a revolving instrument that you can borrow against, and usually that's to be repaid out of your receivables. And there's actually 2 different kinds of lines of credit. A receivables line of credit that most people use for working capital, that you borrow during the month, then whenever you collect your receivables, you pay that line back plus interest. The other is a fixed investment in working capital line, which you use to buy equipment with. And you have to plan on paying an amortized monthly payment on that in order to continually reduce that line, because then you may have the need to go back and buy another piece of equipment next year that you can draw on that same line and borrow again to buy another piece of equipment. And then you again pay a fixed monthly amortized payment to reduce the line each month. And you have that line available then to purchase another piece of equipment maybe in year 3.
I have a question, Jeremy, on the 9th District Development Fund. What is the minimum amount that you all in?
As far as a minimum amount, we really don't have a minimum per se. We haven't dealt with anything really below, probably since I've been there, 20,000. There's nothing in the SOP that states anything as far as amount. I will say that it's based on funds availability. This is a revolving loan fund account. So if we have a pretty good request and it gets approved and that money gets loaned out, we may not be able to meet the need for the request or the full need, based upon what the account balance is at that time. I want to say right now you're probably about, I'm trying to think of what we've got out there, about 160,000 right now.
Okay.
Yeah.
And so is there, and do you have to have a loan denial for that fund?
No, not for that fund. That fund, because of the low interest rate, you would pretty much have to be up to bank standards to an extent in order to qualify for that. They're really looking for real estate secured loans and those type things. I mean, to get that 3.5%, I mean, it's kind of a given. With any of their loans, there is a 3% loan closing fee with those. However, getting that rate, sometimes it pays off to pay that 3%, but they do like to see those real estate secured.
What is the criteria for the type of businesses?
So far, I can give you one of the newest businesses that we've kind of introduced in that was kind of on the fence about whether or not it fell into the tourism business was breweries. And because of the brew trail that has recently been started up, that's kind of becoming a thing now, a fad where people come and they'll travel this trail to look at different breweries. We like to look at it, or the committee likes to look at it as any business that would bring tourists to the area, not just be an addition to what they would do when they already get drawn here. So a restaurant, for example, unless you have something that's going to really show the committee that you're going to draw people to you from outside the region, it's kind of hard to get those through on a tourism base. So zip lining, kayaking, those kind of things, outdoor events.
That's a great loan fund, by the way. I used to work at People Inc., so
Yeah.
I know that fund. That's a great fund.
Are there any brownfields properties in the Abingdon area that y'all are looking to get back in use?
We don't have, I don't know if there may be some in Abingdon, but I don't.
I don't know, that's a good question for Tanya, she's not here tonight, but Tanya Triplett would know something like that. How about you all sharing some examples of where you found a business to get into trouble the fastest, some things, some of these, a number of these are brand new, that are starting up, and it's better to learn those lessons starting out than in the middle of it, but where have you seen some clients get into trouble at?
He mentioned taking on a lot of partners, so you have more people guaranteeing it.
I was just joking.
I know, but I'm saying, that's the quickest.
No.
The scariest is 2 partners. It's tough. What I've always been taught and told people is, you plan the wedding and the marriage beforehand for that partnership, plan the divorce. So in your partnership agreement, have exactly what's going to happen when you break up. Because normally you're both fully guaranteeing the loan. One or the other walks away from the loan, and you may take on more than you could handle because that one's gone. I've seen them actually, one of the pitch competitions I did when I was working for the state. 2 people were combining their businesses, they won, and before they actually started drawing the money, they had a falling out and had to. So luckily they hadn't got any of the money yet, but so partnerships is key. Probably the next one is not paying your taxes. They're gonna get their taxes, so hire somebody to do your taxes. I know as a bank, we see professionally prepared tax returns and balance sheets and income statements, and then we see company prepared. We put a lot more weight on, obviously, the ones that are professionally done. Now, if it's a small business, you're doing a Schedule C, we'll look at those as well. But it's if you're bringing in money and you've got to pay sales tax and income tax, payroll tax, that's 99% of the time, that's not your specialty. Your specialty is whatever that business is. It costs you some money, but it's well worth using it to pay somebody that knows what they're doing to handle that side of it.
A good CPA is well worth its gold.
And
Hands down.
an attorney.
Yeah.
Especially if you're going to be in a partnership. Have that spend the extra money up front and have the attorney get an ironclad partnership agreement so you know how you're going in, what each person's putting in, and how can they, either one of you, or if it's 10 of you, how can they get out of that partnership? Set it up front. Because if it takes off and goes really good, it could, that's when a lot of the headaches start.
I think one of my biggest, one issue that I've seen, probably the biggest issue so far, know where your financing's going to, like we've been talking, know where your financing's going to come from. You can utilize different lenders. You know, that's actually sometimes a really needed thing, more times than any, to spread that out. Beware of lenders that are online that will claim that they'll give you X amount of money for your startup business, this, that, and the other. I'd actually posted on my Facebook here a while back. We had a client that we've done a loan for. They went with this lender, and they're a high risk lender. I call them the payday lenders of businesses, pretty much. They got in over their head. We're talking 32% interest rates on a loan. And you'll see them advertised. There's none locally, but that cabbage loan, I think is the name of the company, something like that. These are high risk lenders, and they will get you in a big mess at a time. Very dangerous, because they'll live on the edge. You don't have to have a 1-to-1 ratio with them. But it's very dangerous. And with us, that's what happened. This business got a cabbage loan. The next thing you know, we're trying to pull together some numbers to try to do either a refinance or a second loan to try to get them out from under this so they can stay afloat. So I guess that would be one of the biggest drawbacks that I've seen.
Yeah, I just echo what these guys say. Partnerships, I don't know whether you realize or not, but if you have a general partner in the business with you, you're just as liable for anything that he takes on as vice versa, as he is liable for things that you. I just talked to a man who was in a business, and he took on a general partner, and this guy was a relative, and the next thing you knew, the guy was driving a new truck, the guy was carrying a laptop computer, the guy had a company credit card, all of this in the name of the company unbeknownst to the other partner, and the company was having to pay for it. And it cost this guy a ton of money just to get out from under the partnership whenever things went south. He would be paying for it for probably another 5 years. It's just a horrible circumstance. If you and hate to say this, but relatives can be just as bad as strangers.
Of course.
Yeah. But failure to plan is just a disaster. I had a friend that used to say, if you fail to plan, you plan to fail. If you don't have a target to hit, you'll miss it every time. Those are colloquial sayings, but they're true. They really and truthfully are. So it pays to plan, be very careful. And the other thing that I see quite often is startup businesses that they get into business, and all of a sudden things are looking really good. I mean, maybe they are able in year 2 to turn a profit, and then all of a sudden they see an opportunity that they have to grow, and they decide, oh wow, here we go, we're going to set the woods on fire. And in year 3 they double, and in year 4 they go out of business because they dry up their liquidity trying to grow the business, either through equipment or paying out for extra inventory or even manpower. It takes money, and that money's got to come from somewhere. So it's usually slow to moderate growth is a whole lot better than fast growth.
I mean, what does that mean? What is slow to moderate?
Depends upon the industry.
Yeah.
And there are resources that you can go out there and look at to determine what the growth rate for a particular industry could be and should be. They give you a range, 2 to 5%, say for a restaurant. If you see more than what the industry says that you can bear, it's just a warning flag.
And you can get that industry average for lots of things too. If you research for it, you'll find it. You can find the industry average for your accounts receivables. How many days it should be, or your accounts payable, what's the normal, the industry average that you're in. All that's on, it's all out there if you just go look for it.
What source would you, do you know of anything?
Robert Morris is probably the best one.
What is it?
Robert Morris.
Okay. Because I'm so paranoid that I'm gonna get something that's not true. There's so much out there.
Sure.
What
Robert
we
Morris
really
is
can-
probably the
can rely
Most
on.
reliable.
most reliable and the most respected.
So this might be a silly question.
No such thing.
I feel it coming though. Just wait. So you guys keep talking about like projections, and I know everybody wants to be top of the game, year two. I just finished my first year of business. How do I estimate where I want to be or should be, or like what do I need to look at to say, okay, this is what I did last year, this is where I want to be in 3 years?
One, look, what are you gonna do different? Are you gonna change your price? Are you gonna cut your expenses? Are you gonna increase marketing or whatever? Look first, how you gonna change? Hopefully in this first, you just said you just got done with 12 months, you really stayed on top of your numbers. You know what marketing or what advertising actually worked, so you're just not throwing money out there at it. You know what times of the year are good for what, I don't know what business you're in, but what, if there's certain times that are better. And so you want to key your marketing around that. Know where you're marketing, who your audience is. Hopefully you know who you were making your sales to in those holidays. So that's, if you were selling to all women, you don't want to be in something that Sports Illustrated where none but men's looking at it, or I made stereotypes in there, easy. But you better be careful. But know where the dollars you spent, how you can make more by spending less, and as you're going forward.
Yeah, look 3 years down the road and set yourself a target, a goal. Say, where do I want to be 3 years from now? Whether that be a sales goal or a net operating income goal. I always would advise you to shoot for the net operating income goal rather than the sales goal, because you can increase your sales relatively quickly and run out of money because you have to increase your working capital, your inventory, your cost of goods sold in order to get there. And whenever you have to spend yourself to death to get there, then your bottom line is going to suffer. But then you ask yourself, how do I get to this goal? Do I have to increase my sales? Do I have to cut my expenses? How do I get there? Do I have to increase my expenses by hiring extra people in order to manufacture if you're in manufacturing? Do I have to buy additional equipment, hard goods, in order to get it to the point that where you can reach that goal? But you look at it and you say, where do I want to be? And then you look back and say, how can I get there from here?
And have somebody else look at your numbers to see if it makes sense to them. And make sure you're truly counting all your expenses you're going to have. I've seen projections that they didn't have. I got a great example. It was a bakery. The lady said that she was going to make this much. And I said, well, how many items do you have to sell to get that? And she said this. Then we started taking off all the ingredients, her time, the overhead, and it tripled the numbers. She's like, well, there's no way in the world I can sell that. Well, good. Now you know before you got into it. Truly have somebody look at you, because you're going to forget something that's in your expenses probably. You're thinking of all the normal things, your cost of goods sold, and the utilities, I mean, everything in there. Just have somebody look at it and see if there's something that just skips your mind. Because you don't want bills to start showing up and you go, ooh, I didn't count that when I priced this. So it's hard to go right into business and immediately start raising prices for either services or goods.
And in past years, if you've been in business, say you're on year 3, for example, in the last 2 years, you've seen certain key items or certain things in a certain field that you've had to make a substantial purchase at some point in time of the year. Based off mine in the past, my prior position was a district manager for a finance office, and one of the problems that I ran into when I was creating budgets for different offices and then or reviewing P&Ls is I would get 7 months into my year, realize that everything was going good, and then one of my centers would bonus and blow that whole budget out of proportion, only because I failed to create a line item and had an imaginary figure based on my trends in the past for key item purchases. So, if you've got we can use something small. If you've got a $1,200 purchase that you see that tends to come up every 2 years or something, it's good to budget. Even if it's $100 a month on your P&L, it's good to budget for that so that you don't get with a $1,200 hit all at once. Or I use $1,200. What if it's a $12,000? A big piece of machinery or something. So I think too, with the question you ask about where do I want to be, I think debt pay down is a big thing. If your cash flow is getting better on year 2 than you anticipated, then maybe year 3, like he was saying, focus on your bottom line. Maybe year 3, your goal is to pay down some of your debt associated with the business, so that you can have a better cash flow and a better bottom line. So.
Yeah, and be realistic about your expenses.
Mm-hmm.
And make sure that in your projection you have all of your items covered. I looked at a projection not too awful long back, and it's kind of funny in a way, but the guy showed me his projection, and I said, this looks pretty good, but I can see one thing that you missed, and said, what's that? You're not paying yourself anything. Oh, that's a big item to leave off of your projection. Are you going to pay yourself anything out of this? If you're not, then don't expect to pay yourself anything out of this. You're going to be in the hole before you even get started. And that was a very important item to leave off of a projection, was what he was going to pay himself.
And we hear that a lot. I'm not going to take any money. And then we look at their personal financial. How in the world are you going to live? You don't have another job. How are you not going to take money out of the business? So if you say you're not going to take money, make sure you can prove you don't have to take money.
You've got, when we look at the debt to income ratio with us, you've got 3 major figures that we're going to look at. Number 1, your debt to income on a personal level, and like they're saying, what you're going to pay yourself and what you're going to cover there. Number 2, your business EBITDA and how that comes out. And then your global. If the business is, with us, if the business is going to be a startup business, going to be kind of on a fence, and you're retaining your full-time position and doing this business on the side, how does your personal income look? If need be, would you be able to utilize some of that personal income to sustain another payment and those type of things? We actually have a program that if you're $10,000 and under, and you're still going to retain your outside job, then we don't go completely off of cash flow projections. We can sit down with a short 12-question, 15-question questionnaire, look at that, and as long as your income outside of the business, your personal income will sustain that payment and it'll fit into your debt service coverage on your personal level, then we'll look at doing a $10,000 loan or less for that. So that's an important key to keep in mind too.
I want to explain EBITDA.
Yeah, EBITDA would be your earnings before interest, amortization, depreciation. When I look at a tax return, when you're looking at that bottom line and you say you look down and you took a $20,000 loss, well, if $10,000 of that is in depreciation, that's not really a monetary loss. So we get to add those type items back in, as same as interest that were paid to banks on business loans. some banks go off your taxes too, they'll use that. We don't particularly look at the taxes aspect of it, but, or what taxes you paid, but we'll primarily go off depreciation and interest paid on business loans. And we get to add those back into the bottom line. So on a tax return, what may look like a $20,000 loss is a loss in depreciation as well, so it may not be a monetary loss.
All of that goes into determining what your cash available for debt service is.
Right.
That's actually the cash that you have that you can pay a monthly payment out of.
On the 10,000 that you were just talking about, you have to have a bank denial for that one too?
Yes, because we're still utilizing the SBA funds. The beauty of the SBA funds that we have, People Incorporated, we go off of our guidelines for qualification for that. And one of the things that we implemented, what we didn't want to have to do is when you have that bank denial and you're coming to us or the bank wasn't able to do it, it may not be a flat out denial, it may just be something that the bank can't do. What we were trying to get away from is requiring those folks to do a low loan amount, requiring the same thing that somebody coming to us for $100,000 would require. So it's kind of something we implemented. Like I said, you do have to retain your income, your job outside of the business. So the business income would not play a part in any way, shape, or form.
At what point do you start paying yourself? And how do you figure out how much you're supposed to pay yourself?
You got personal bills day one.
Yeah, right from the beginning.
I mean,
It's just another line item on your projections.
I mean, that's a great point. If you're setting out in a business and you figure all of your expenses compared to your sales minus your cost of goods sold, and you come down to the bottom line and you don't have enough money left over to pay yourself, do you want to even get involved in this business? I mean, that's what we're all in business for, is for the paycheck. And if we can't see our way clear in our projections to pay ourselves a paycheck, then do we want to even get involved in it to begin with?
I know, like I've heard that it takes like a year or sometimes 2 or 3 years before you actually start. You're saying if you don't see it like straight out.
Well, if you say you go into your business and you've been doing this for 6 months and you've got personal things that you have to pay outside of bank notes or anything that you may have in your personal name, you've still got cost of living that you've got to provide for yourself. If you're into this 6 months, now give you a scenario. If you're in this for 6 months and you've not been able to pay yourself, but just a very little bit, at some point in time, when a bank or a financial institution invests a loan into this business, at some point in time, if that's the case, you're going to say, you know what, I give up, I'm going back to work. Well, then everything that we sit down and projected as far as income and those things go out the window, and everything's based upon a job now that probably won't pay as much as you anticipated, or you wouldn't have pursued that adventure to begin with. So, I mean, the part that where people say, you know, you usually don't pay yourself until 2 years after that, I would say it may be because they've had a spouse or someone living in the household that's helped front that money for the bills, and they pretty much ain't had to provide a living for themselves, and the spouse have supported that, or a friend or whoever. That's the only way I know to answer that question. I've never seen a person stay in business. I know personally I wouldn't do anything unless it was out of the kindness of my heart for somebody. I wouldn't start up a business and be in it for a month if I knew I wasn't going to make myself some money, personally.
Well,
So.
see, like when I started, I guess I'm blessed enough to say that I've put into my business less than what I pay monthly for my car payment when I first started. And ever since it's been taking care of itself, I haven't gotten anything from it. But I'm putting my time into it, and so that's why I say, you know, eventually I do want to start seeing some money come my way, you know, and I can tell that I will eventually, but I just don't know when it starts happening, if it's too late, or, you know, like I think that's gonna.
It depends on how long you can stand to go without. Your personal bills either have to be paid from your net operating income, your net operating income, or they have to come out of your liquidity, your bank account, one of the two. And either you have to get your net operating income up enough to the point that you can pay yourself out of your net operating income, or your liquidity is going to continue to shrink because you've got to take it out in order to pay yourself, in order to pay your bills.
And that's kind of our situation, is we're trying to preserve our funds that we have raised as far as our capital resources for infrastructure purchases. And so that's kind of the model where we're not paying ourselves, because anything we do pay ourselves comes out of our kitty that we have available for the long term. And with our industry, it's going to be a long-term delay in satisfaction by the time we get through all the regulatory processes and get a positive cash flow and product on the shelves. So we're every penny we can leave out, because we've worked hard to raise that, what we have so far. That's kind of a scenario towards what you're discussing, where we've got an incentive to leave that there.
When you've got a kitty set aside, I guess off paper, that's pretty much a working capital, because your salary is considered an expense of the business. So pretty much what your kitty's doing is just supplying that particular portion of the working capital, which involves salaries. And at some point in time, you have to decide, you know, if you say, well, when should I start making money? We should be as soon as possible, but no later than that kitty runs out, of course. So once you run out of that working capital, or that particular area of working capital, that's when you want to say, I want to be making a salary, you know, prior to that, in my opinion.
But it also sounds like y'all are saying that there's, and this is probably a real naive thing to say, but I feel like I'm just sort of repeating that it sounds like you're saying that there's a difference between getting a salary and having a profitable business, right? Because even if the salary hurts the profitability of the business, it's important to be able to do that, and that just becomes a part of your business expenses. Is that right?
Yeah, to a certain
Otherwise,
extent.
otherwise it's a hobby.
Otherwise, yeah.
If you're never making any money out of it.
Right.
Yeah.
I know family-owned businesses where people only take really a stipend out of the business. But, mind you, the business, they write checks out of the business to pay car payments.
Right.
And they are considered to be business vehicles, but they use them for personal business as much as they do for, and it's family owned. It's family owned. And they don't have any shareholders or anything like that to have to account for. So, yeah, they pay themselves really relatively well whenever you consider everything that goes through the balance sheet and through the profit and loss. They really pay themselves fairly well.
I guess the other model would be is if your goal is to build the value in the company, in the equity, in the contracts, in the market share of that, and in that case, you know, you get paid on the back end rather than in kind of dividend style.
I've seen people build businesses for the sole purpose of selling it. And they don't reap any reward on the front end, but 5, 7, even maybe 10 years down the road, when they sell it, they'll make a huge amount of money because they've built up that capital in the business. You're exactly right.
I've got a question. Next week, they're doing their business pitch, and everyone that comes and gives you a, application or business plan, they're pitching their business idea to you. Can you share some tips of these folks that they need to consider, especially for next week, but when they move forward, what they need to consider when they go talking to lenders about their business?
Know how much you need, why you need it, and where you plan to get it from. And have an exact number. You're never gonna start a business for $7,500 on the dot.
And be able to back the numbers up with something.
Just, I mean, this is something you guys have thought about forever. When all the judging I've ever done on these, the people that normally win, you see the passion first. It's something they've wanted to do forever, and they've not just wanted to do it, they've prepared for it. This is something they've been, some people 10, 15 years before they were ready to take the step. And competitions like this help them take that step because there is a monetary amount you can get from it. The passion, why you're passionate about that, and why you're willing to maybe not have a paycheck for a year or 18 months. Your numbers are key. I mean, obviously, I'm a banker. If you can't tell me the numbers backwards, forwards, side, left, right, and know where you got them from without freaking out when somebody asks you a question about it. And I've seen people pitch and say, I'm opening a restaurant because I love cooking. It's going to be rough.
One thing that I'd like to add when he's talking, we spent a little time talking about taxes, doing your own taxes. Before I moved here, I had a remodeling business in Kentucky for 17 years. I started out, had a bunch of jobs lined up, had a great first year, and called around to get some people to do my taxes. Well, they're out of their minds. And I like to brag on myself that I'm smarter than I look, so I went down and got me a TurboTax. I did it. Everything was fine. I had to pay a little bit, and I expected that, because I made quite a bit of money my first year. I was all proud. So I got a letter in the mail. And that letter got me an audit. I wished I would have paid the $200 back in 2001. Because if you've never went through an audit, it's murder. After that, I always had someone do the professionals. And I don't care what I had to pay, sitting at the kitchen table, going over everything, it's not worth it. I'll tell you that right now.
Especially if you end up owing and Uncle Sam waits till
Well, I
about
already
5 or
wrote
6
one
years
check.
down the road and you get all that interest too.
I got to write another one. Yeah.
I
Good
agree.
old TurboTax. Yeah.
I agree 100%.
Yeah, so that's my advice.
The tax laws change so much, it's hard to stay on top of.
That's true.
It's really hard to stay on top of.
But good luck. Don't be scared of it. Just I look all the way around.
I like to look at it as if business wasn't risky and it didn't make you call, or didn't cause sleepless nights, everybody would be opening up businesses.
Like that guy
Everybody would be doing
commercial,
it.
even a caveman could do it.
Yeah.
And it's real easy for us to sit up here and tell you because we work for somebody else.
You get a paycheck.
That's it.
We've heard the term sweat equity, okay? And looking at whether or not we need to pay ourselves or not, we're retired, okay? We have a guaranteed income, a personal income. Our business will be separate from that. But sweat equity is what we intend to pay ourselves with for the first year till we get our feet on the ground. Because with the challenge, they say that we don't have to have an employee that first year. I'm the employee, my name on the line. So if I'm willing to do that, looking at a business plan, are you gonna look at that and consider that? Is that gonna be a strike against me?
It's not gonna be a strike against you with us, but we're not gonna count that as your equity injection into it either. So if, like when I went back to the 100% of the project, we would look at maybe doing around 80% depending on the type of business and the collateral. You couldn't say my sweat equity is 20% of it.
And if I've been saving for the last 10 years, I did work to get this done, that's my.
Well, yeah, that's your cash, or like some people, say a mechanic, he's been a mechanic him or her has been a mechanic for 20 years, and they've got 20 years worth of tools and equipment. That can be equity injection into it, but it's hard to put a value on.
And a building.
On sweat, the whole building, absolutely.
Building and those.
Something tangible you can put your hands on
Yeah.
is equity.
Okay.
It may be cash, it may
So
be,
sweat equity it's acceptable in that regard, if I've got the building, I've got the.
When you
well, it's
say
not sweat equity when you got a building, that's true equity,
But I
because
mean,
you got a value.
I've got the building, I've got the sweat equity, I've got the, and if I just need to start from that.
are you identifying sweat equity as what you've done in order to produce this building?
No,
Okay.
no, I'm identifying it as what I'm going to be putting into it, my 5 days a week, or 7 days a week, or
Okay.
whatever the time I'm there to run this business.
Yeah, that's when we talk about 80-20 or 90-10 or what have you. The problem with that 20% of sweat equity that you might consider, it can't be liquidated in the event of a default or something like that. If we have to look at it in that sense, we can't recuperate the loss by the 20% of sweat equity that's put in there. So that's why something, if I'm reading this right, is something has to be that 20% has to be liquidated somehow, or be able to be liquidated at some point in time.
But it's specifically saying I'm not going to take a salary out of that business. It's not that part.
No.
It's not gonna go against me in looking at business.
Oh, no.
Not in your case, because
No.
you were talking about personal income that you have.
Right.
Like in my case, and I shouldn't speak for these gentlemen, but you're looking at a global income when we encompass your personal debt, your personal income, along with the business.
Yeah.
If that's the case, you're not going to be paying yourself, then we may look at it from a global, and to use the word EBITDA again, we may be looking at it from a global EBITDA, which is encompassing your personal income, your business income with your personal debt and the business debt all together.
Because frankly, I don't think it would work Monday in order to pay my car payment,
Right.
that kind of thing. Thank you.
Does anybody have questions for them regarding what they look at for business plans? Keep in mind, that's a big part of your scoring, is your business plan.
Big part scoring on pitch night or just
The overall.
I have a question, and I can't find the words. That's why, but I'm gonna try to bear with me. Okay, so I'm competing as a new startup, but I've been in business 6 months, less than a year, 6 months. And I have my original business plan. This is 6 months ago, and y'all talking about how it's amazing how you leave things out. It's great. Looking back at it now, I'm gonna go, wow, I wasn't way off. Like, I did all right. But thankfully, I can kind of flip back and change the numbers and add some things and be more accurate with my projections. Because that's the tough thing about starting a business. I mean, when I met with Jeremy, I don't know if you remember, back in the summer, and, I thought, well, I don't know. What do I do? How do I get money? And how can I have you take a chance or a risk on me when I have nothing really to show? And how do I, and I feel like, so what I'm trying to say is, I said this is how much money I needed, which I still, that's what I needed. But we don't own our house. We haven't paid it off. We didn't have any equity. So what would you tell somebody? Because I felt like, well, how the heck do people do it? That may not have even a car paid off yet. Which we were blessed and we had family. That's what happened. They stepped in and we got it quicker because we needed the money quick to buy our equipment and such to get started. But what would be your advice on, I guess that's one question. I went away from my original question. But what would be your advice? How would you deal with somebody like that? Could you help them at all? Or I was blessed because my husband works and he's full-time and so that we could show that, right? Because you take that into account.
Well, we would look at your past too and see what your background was, see if you have the expertise. There's a lot of different businesses out there, and some of them require a skill set, some of them don't. If I walked in and said, oh, I'm going to open a brewery, you better not invest in me because I don't have a clue. I don't have the expertise. Even if I did have the capital, first thing I'm going to have to do is look for somebody, hire somebody, and pay them probably a pretty good size salary in order to do the job because I don't have a clue how to do it.
But you would take that into account if they said, okay, I don't have any, I'm fresh out of college.
Mm-hmm.
I went to school for business management. My whole family has always own businesses. I get it, you know, and I'm ready. That's all I got. I mean, that does play a part. I mean,
Yeah, you may have to start small.
Yeah.
yeah.
You may have to
That's what we
get,
did.
and you may have to get family involved, but there are ways that you can do that, and there are ways that banks, that lenders can help you. And a lot of that too has to do with your history, your prior credit. Even before you start business, you've got a character out there. Your character is most either good, weak, moderate, or it's poor, you know. And whenever we start, the first thing we do is we pull a credit report and look at your character. You know, even though you haven't been in this business before, how many years of history do you have out there where you have done an excellent job of managing your business, whatever that may be?
3 kids.
Yeah, sure. Yeah, that's a job too.
And sometimes the best answer is no. I can't give you a loan. We're not gonna give you, now's not the right
I've been
time.
told, yeah.
And it may not be. I mean, there's a lot of people in here, right? Everybody might not be ready to open a business today.
So
So
sometimes
maybe it's not.
sometimes it's not what you do for somebody; it's what you do to
Oh.
them. You remember that?
That's a
saying?
P-point slogan right
Yeah,
there.
I mean,
He
you
is
know,
still reciting, that's
they,
good stuff.
yeah, they. I mean, I've had folks come to me and we've sit down and talked about business plans and what they were going to do, and then right off the bat, you know this isn't a good idea for them to do this. Whether it be the type of business they're going into, and it just, you know, you've seen several businesses that you did loans for go in default under that same area that they're going into, or you know, just financially, it just doesn't make a whole lot of sense for them to go into it.
This might be still another, I can't wrap my mind around what I'm trying to ask. But when I started up, see now I'm fresh, but I've been doing it for 6 months, I'm learning. I wanted X amount of dollars. This is what I felt like I needed to cover all my equipment costs, and what I need to get started. And I wasn't far from it. As far as the business plan goes in this competition, should I use that number that I originally came up with, or the true number that I ended up? Like I wanted X amount of money, but I ended up getting it in different ways. I had to give some of my personal, you know, to kind of fill in the gaps,
I
$5,000
think you
bucks.
want to show both.
You
One
can-
thing I looked at.
You can do a column-headed budget or projected, and then you can do a column that says actual
Okay.
for 6 months.
Because I think it's neat
And-
to show.
And you may want to blend the two together for your two. Or you may just want to build on the actual numbers, depending on what your goals are and what targets you're shooting for. But at least you've got something started. You know, in order to increase your net operating income by a certain percentage, what you're going to have to start with at the top in order to get it to come out at the bottom.
Because I couldn't decide what number to
Yeah.
use.
So as we've been using the standard model that a lot of folks have suggested, which is the first and best person to talk to about loans or those closest to you, friends, family, people interested in seeing you succeed. When you're evaluating plans, and you could have a host of, from an outright gift to somebody who's would like to be paid back if it's feasible, but still considers it a gift, all the way to, you know, kind of the more traditional investor. Could you discuss a little bit about how to document that, or different structures, or if as lenders, if you're looking for where you would be looking for gift letters, or what that threshold would be as far as characterizing and documenting those different types of gifts and or investments or loans?
Yeah, you're definitely gonna have to be able to show if it's a debt or if it's a gift, because it's gonna affect that 1.2%. Just, we want it to cover ours, but it's gotta cover any debt. So that debt number that he mentioned at the bottom is gonna be all the debt you have on the business. So if it's, it could be an agreement with whoever's giving you the money. You could have a note. I mean, if he's letting you borrow the money, he could drop a note just the same as the bank does. But yeah, I think you want to show it all. One thing I heard at one of the competitions I did, the guy said, "I'm putting $100,000 of my own money into this, but I don't want to tell the judges that because they'll think I don't need theirs." That was, I thought, the craziest thing I'd ever heard. If you're willing to put $100,000 into this business, and I've got 20,000, I may be more willing to give you 20 or 10 or 5 or whatever it may be. You want it to be a true representation of what you've already put into it, what you're willing to put into it, and where it came from. If it's family, if it's money you've saved, if it's items you've already bought. I think you're with the cider. So if you've already bought stuff to where you're probably already tinkering and making and playing. So yeah, I'd put all that in there.
Is there a standard format for gift letters, or can it be
with us, it's going to be we would verify everything. We wouldn't just take the letter. We would take the letter, but we'd contact whoever we try to verify, and then we'd probably show where they've actually given it to you.
Bank transaction?
Yes.
If I was going to get a letter, I'd go as far as to have it notarized.
Yeah.
Okay.
You know.
Is that something that we could do proactively and have on file for an investor or a loan lender portfolio?
Yeah, because I mean, even if it's not required, it's good for you to have.
Yeah.
Because they may come back later and say, "Well, I meant that to be a loan. You owe me X amount of dollars," and it could be a family member. It still came. You start making a lot of money, and they're like, "Well, he ought to pay me back. That was a gift then, but maybe I need it now." So.
And I promise y'all aren't putting me to sleep. I've got an eye condition this week, so.
Not to shift.
Banking can put you to sleep.
Yeah. Not to shift in another direction. We were talking about partnerships earlier. A lot that something I've seen a lot of is particularly with LLCs that get started up. When they go set up their LLC, they're real quick to get an articles of organization set up, but they're not real quick to getting an operating agreement drawn up. That's real important when you're setting up a business, particularly an LLC or an incorporation, so that we can identify who and what the duties are of the owners of the business. I've got to, if I've got two individuals coming in as a lender, I need to know who needs to sign on behalf of that business and who, as far as the business, is completely irrelevant. And it'll show your operating agreement, if it's done properly, particularly through an attorney or something, it'll outline what the duties and responsibilities of each member of that LLC holds. So when you got to talking about gifting and things of that nature, it kind of brought that to the forefront of my mind.
That's really more important than articles of organization.
Yeah.
We can go on the Secretary of State's or State Corporation Commission website and see that it's organized, see what the name of it is, what the address, who the organizer or registered agent is, even perhaps depending on the state, who the officers are. But none of that tells us who has responsibility for the day-to-day operation of the organization. That's what the operating agreement does.
The State Corporation Commission's website will also release or show us who has any blanket liens or UCC filings on the business as far as equipment, inventory, and those kind of things too, if they're filed properly.
Yeah.
Sometimes. Yeah, exactly. Sometimes you get on there and there's a blanket lien on everything, but it doesn't exist.
At what point can a business move from a personal loan to a business?
We wouldn't make a personal loan for a business. It's going to be a business loan.
But
it ties you both. It ties the business and the individual up anyway.
Right, but it's a personal guarantee, right? I mean,
It's personal guarantee.
Yeah, the
You're
loan is to
standing
the
behind.
business, and then you, as the owner of the business, personally guarantees it. Yeah.
Right.
Instead of just doing a personal loan that doesn't tie the business to it anyway.
We're talking about funding sources. I assume even if part of your money for startup comes from a family member, it's good to document that formally, whether it's a loan agreement or a gift or whatever. Do it in writing, I assume, and notarize it, that type of thing.
It's the same. I like to compare it to the same as if you have sons or daughters or whoever that's going to go buy a home and their down payment is coming from a father or a mother or something of that nature. The bank's going to require to show where that money's coming from to make sure it's not a debt that's showing, a a debt that's not yet shown on a credit report or something. You have to show where that money's coming from, savings, whatever.
Back to the business plan, one of my concerns is too much what they call fluff. I'm paranoid because I have all this information that I wanna get out there and get down, but I also wanna keep you focused, the potential investor or whoever's looking at this plan. What is fluff? I'm confused I don't wanna put too much in where I'm not, what exactly do they want? What do they not want? What do you not want?
We don't want fluff. No, I'm just kidding.
What's
I believe
I couldn't
it.
resist.
What is that, just repeating
Keeping
the
it
same
simple.
thing over and
Keep
over?
it simple.
Yeah.
Yeah, keep it simple. The facts. What we want to see as far as a report that you're going to be generating is just something that we can look at and say this is substantial, and where we don't have to go in and take a marker
Right.
and mark out the BS.
Right.
You've been in business for 6 months, so you went back to your business plan.
Yes, it's all
So
fluff.
it's the items in there that were important to you are gonna be important to whoever's looking to invest or lend the money. If there's items in there that you haven't looked at in 6 months, they probably don't need to be in there.
I saw Dean's hand back there.
Yes, let's shift gears for a moment away from startups into ongoings. And when we're looking at the business plan, as far as our financials go, when we have years of historical data to draw from, should we do an average of a certain amount of years, or I'm kind of in the dark about how to get
I would
financials.
use your last 3 years and use actual numbers. And then your projection is going to be how you're going to get to your target. You're going to say, I want to increase my net operating income, or I want to increase my sales over the next 3 years by X percent, and you would just show us how you're going to get to that number. But it's great to have actual numbers. That makes the banker's job much easier when you have actual numbers, even 6 months worth of actual numbers.
That goes the same when you're purchasing a business too, although change of ownership typically will cause a dramatic change. It can either be down or up, but having those actual numbers will show us what the business is able to do if it's ran. If it's been a profitable business, what they can do. So those numbers come into play there too.
If you're buying somebody else's business and they're not willing to share with you the historic numbers for the past several years, don't buy it.
Yeah.
Just pass.
It'd be kind of like going to buy a used car and they'd be like, Carfax, you don't need that. Don't even worry about it. Take my word on it. Yeah.
Another question regarding existing equipment and stuff. If it's been fully depreciated, if, say, like some of our framing equipment has been in existence and is fully depreciated, how do you include that in your assets?
What would you sell it for?
Yeah.
Okay.
Whatever
What
the
do you
resale
figure
value is.
its actual cash value
What
may
its
be?
market value.
Yeah, what its market value is. You can even go on eBay and places like that and see what stuff is selling for.
Could you use a use value, like if that piece of equipment's bringing in so many dollars a month versus a sale value?
That would
No,
be hard
because,
to estimate.
well, and if we ever took ownership in it, we're not gonna be using it. We're gonna be selling it, so it's the sell value.
And like with us at People Inc., that comes into play too when you were talking about the depreciation of it. The first thing I'm gonna do is like Jeff said, I'm gonna go on and see online, what's this particular piece of equipment selling for? And then, you might not get that full amount of collateral value, for lack of better words, out of it, simply because if it's, say it's, trying to think of what I could use here. a big press, for example, like say it's some type of steel manufacturing, and they come in and say, well, we got this big press. Well, one thing we have to take into consideration is if you took a crane to get that thing in there, and you're wanting to use it to collateralize something with, we've got to take all of those costs into consideration. So, but going online and getting that starting point of a sale price for that particular piece will kind of give us a starting point, and then we can work back on that.
What are your online resources?
In the last few loans that I've completed here lately have been the short or hot shop hauling businesses for people that are buying like 18-wheelers and those type things. Not on a mass scale, just one truck, one trailer. I've used like truck paper, or I think it's truck paper or truck sales, something like that.
So if there's industry specific.
There are.
Yeah.
That I would have to identify with that.
Are there any dealers that trade in used equipment like you use in your industry?
There are.
So that's where you would go to see what they're buying and selling for. We had a press one time when I was at Mountain City. I think that it was probably 50 years old. It came off of a destroyer. And whenever it come time to sell it, we had to pay somebody to get rid of it.
Oh, yeah. We've got one. They had to cut the concrete out because the hydraulic fluid and oiling comes up from the bottom. And I'm like,
Anybody have any more questions? Know everything you're gonna do next week?
Yeah.
Thank you to our panelists. Thank you for these gentlemen, I know that they'll help you some more if you have any other questions.
I'll leave my cards in the table back there.
I'll leave my cards back there as well if you.
And Jeff, you gonna leave your cards too? Okay. Great, I would agree. Yes, Dean?
Before we adjourn, I have an announcement that I would like to share with the group. The Gallery Bar Photographics is having an art opening on Friday from 7 until 9. Our artist is Frank Herzog. He's a Radford artist. He has a brand new show at the gallery. Come out, 7 to 9, meet the artist and have some refreshments. Thank you.
Thank you. Also, we need for you to fill out your little form, whether you're gonna let us take you next week. So please fill those out tonight. On the first line, you want us to, the second line, you don't.
Where are they?
They're right over there on the table. Any other questions? I think Donna was gonna say something.
Oh, I just wanted to see if anybody was interested in going to grab a snack and or a beer or something like that after class. I just thought it'd be fun to get together and talk about stuff if we wanted to, maybe ideas for the pitch night. Or we can do it next week after the pitch night. I'm up for tonight.
Hey, also, we're gonna have Getting Back to the Basics Digital Foundation tomorrow at our Lunch and Learn. So if you don't have anything tomorrow, and you wanna stop by at 12 o'clock, please stop by. So any other questions? Okay, we'll see you next week. Good luck to all of you. Thank you.